Hello and welcome. Based on a request from a subscriber, we are going to do a A-level question from paper 3, which is same in variant 31 and 33, May-June 2018, question 1 based on manufacturing accounting. The question states that JH Limited is a manufacturing business producing a single product. The transfer price of finished goods to the income statement is cost plus a fixed percentage for factory profit. This percentage has remained unchanged for many years. The following information is available for the year ended 31st October 2017. Prime cost is $252,000. Work in progress at 1st November 2016 is $28,000. At 31st October 2017 is $32,000. Inventory of finished goods at transfer price at 1st November 2016 is $108,000. At 31st October 2017 is $96,000. Revenue is $1,860,000. Then factory overhead is $461,000. Distribution cost is $216,000. Administrative expenses is $412,000. Finance charges is $28,000. Provision for unrealized profit at 1st November 2016 is $18,000. The following information is also available. First, included in the distribution cost are carriage inwards, which is $18,000, carriage outwards, which is $34,000. Second, administrative expenses include an amount of billing insurance of $60,000. The following items related to billing insurance has not been adjusted. An outstanding unpaid invoice of $3,000 for the year ended 31st October 2017. A payment in advance of $1,000 brought forward from the year ended 31st October 2016. The allocation of 75% of the total to the factory. In the bit of the question, we are asked to explain why a manufacturing business might prepare a manufacturing account as a part of their financial statement. You see, when the business makes a manufacturing account, it calculates the factory profit and the factory cost. Hence, it helps the management to access the performance of the factory. Furthermore, as the costs are allocated separately for the factory and for the official use, hence it helps the management in controlling the cost in better way, as the cost can be identified with specific cost centers. And moreover, a manufacturing account also helps the management in make or buy decision. That is, it helps them to understand whether they should buy the product from the outside market or make it in-house. Why? Because it allows for a comparison between the cost of manufacturing a product in-house rather than buying it from the outside supplier. And as we calculate the factory profit, this can also be used for giving a specific reward based on the performance of factory managers. And when the factory managers are rewarded based on their performance, this will be a means of motivation for reducing the cost of production in an efficient way. In the B bit of the question, we are asked to prepare manufacturing account for the year ended 31st October 2017 in as much details as possible. So we'll start with the working notes. From the first adjustment, it is stated that included in the distribution cost are carriage inwards and carriage outwards. Carriage inwards is the transportation cost paid to get the raw material to the factory, and this is the part of cost of material consumed, which is an element for prime cost and not a part of distribution cost. Hence, this was wrongly allocated. Whereas carriage outwards is a transportation cost which is given to distribute the finished products to the customer, and this is the part of distribution cost and it was rightly allocated. So we do not need to do anything for carriage outwards, but we have to rectify the error made regarding carriage inwards. So now to rectify this, we'll take the prime cost, which is $252,000. To this we will add the carriage inwards, which is $18,000, and now we get the prime cost as $270,000. And we will rectify the distribution cost by taking the value which is given as $216,000. From there, we are going to subtract the carriage inwards, which is $18,000. We get the distribution cost as $198,000. Second, The adjustment states that administrative expenses include an amount of building insurance of $60,000. The following items related to the building insurance has not been adjusted. An outstanding unpaid invoice of $3,000 for the year ended 31st October 2017. So this is an accrued expense for the year for which we are making the accounts, and this will be the part of the building insurance for this period, hence it is added here. Then a payment in advance for $1,000 brought forward from the year ended 31st October 2016. That is, this is a prepaid expense which was done in the year ended 31st October 2016 for the period of year ended 31st October 2017, and for this period we are going to make the accounts, hence we are going to add this back as an expense for building insurance. So now our building insurance will be $60,000 plus $3,000 plus $1,000, which will be $64,000, and out of this 75% should be allocated to the factory. So 75% of $64,000 will be $48,000. Therefore, now our factory cost will be the factory overheads plus the building insurance for the factory. So we will get the value as $461,000 plus $48,000, which will be $509,000. Then the rest is for administrative expense, and it will be $64,000 times 25%, which is $16,000. However, $60,000 was allocated to administrative expense, that is $44,000 overestimated expenses for building insurance was added to administrative expense. That is, from 60,000 when we subtract 16,000, we will get $44,000. 16,000 was the right amount which should have been added to administrative expenses. However, 60,000 was added, hence administrative expenses was overstated by $44,000. So to rectify this, we will take the administrative expenses, which is $412,000. From there we are going to subtract $44,000. We get the value for administrative expenses as $368,000. In the third working notes, we will calculate the markup percentage as it is not given in the question. However, the information states that the markup percentage has remained same for many years. Hence, the markup percentage of 2016 and 2017 will be same. For this, the information which we are going to use is the provision for unrealized profit at 1st November 2016, which is $18,000, and the inventory of finished goods at transfer price at 1st November 2016, which is $108,000. For markup percentage, we have the formula that markup percentage is equals to profit divided by cost of goods produced times 100. So for profit, we are going to use the provision for unrealized profit at 1st November 2016, which is $18,000. You see, the provision for unrealized profit is the provision which is made because the factory profit is not yet realized from the unsold finished inventory, and as it has not been sold yet, this cannot be recorded as factory profit based on prudence concept. Hence, we make the provision for this. So we are going to take this as the profit, which is $18,000, and we are going to take the value of inventory of finished goods at transfer price. Transfer price means this include the cost of goods produced plus the factory profit. So if we subtract the factory profit from this, we will get the cost of goods produced. So I did this here where I have taken $108,000. From there I have subtracted $18,000. It will be equal to $90,000, and then I have multiplied the whole thing with 100. I got the markup percentage as 20%. Furthermore, we will also calculate the provision for unrealized profit at 31st October 2017. This will be used when we go for the C bit of the question, where we have to make the income statement. So for this, we are going to use the formula, that is provision for unrealized profit at 31st October 2017 is equals to closing inventory of finished goods at transfer price, and this will be the value at 31st October 2017, which is $96,000, times markup percentage, which is 20%, divided by 100 plus 20. So I have done this here. So we get the value for provision for unrealized profit at 31st October 2017 as $16,000. The rules for provision for unrealized profit will be same as the rules for provision for doubtful debts. That is, the amount of increase in the provision is subtracted from the factory profit when we make the income statement. And if there is a decrease in the provision, the amount of decrease for the provision will be added to the factory profit when we make the income statement. Here, the provision for unrealized profit from 2016, which is 18,000, have been reduced in 2017 to $16,000. So there is a reduction of $2,000, and this will be added to the factory profit when we make the income statement. With this, we have completed all the workings for manufacturing accounts as well as for income statement. Now let's make the manufacturing account for JH Limited for the year ended 31st October 2017. We'll start with the prime cost, which was calculated in the first working notes. Then to this we will add the factory overheads, which was calculated in the second working notes. Then to this we will add the opening work in progress, from where we subtract the closing work in progress. We'll get the cost of production for the goods manufactured as $775,000. Then we have calculated the markup for factory profit in the third working notes as 20%. So we'll take the cost of production, which is $735,000. With this we multiply 20%, we get the value as $155,000 as factory profit. Then we'll add the factory profit and the cost of production. We'll get the value as $930,000, which will be the transfer price of the finished goods to the income statement. With this we have made the manufacturing account. In the bit C of the question, we are asked to prepare the income statement for the year ended 31st October 2017. So let's make the income statement for JH Limited for the year ended 31st October 2017. We'll start with the revenue, which was given as $180,000. Then we'll take the opening inventory of finished goods as $108,000. Then the transfer price, which was calculated in the manufacturing account as $930,000. Then the closing inventory of finished goods will be subtracted as $96,000. We will get the cost of goods sold, and once we subtract the cost of goods sold from the revenue, we get the gross profit as $918,000. Then we'll take the factory profit, which was calculated in the bit B of the question as $155,000. Then the decrease in the provision for unrealized profit, which was calculated in the third working notes as $2,000, and we subtract the distribution cost, which was calculated in the first working notes. Then the administration expenses, which was calculated in the second working notes. We get the operating profit as $509,000. Then we had the financial charges, which will be subtracted. Then we will get the profit for the year as $481,000. Furthermore, additional information is provided. The selling price of one unit is based on the transfer price from the factory plus a markup. Bob, the financial director of JH Limited, has been notified that their main competitors has increased prices. He wished to increase the fixed percentage of the transfer price by 5%. The other directors are concerned that this will affect the profit. In the debate of the question, we are asked to advise the directors whether or not they should increase the transfer price, and we have to justify our answer with the relevant calculation. So I have started doing the calculation in the working notes first. So for this I have taken the part of manufacturing account which will be affected. That is, I have started from the cost of production of manufactured goods, which is $775,000, and on this we will add the markup, and now the markup has been changed from 20 to 25%. So 25% of $775,000 will be $193,750. And because of this, the adjusted transfer price will be $968,750. Then the adjusted income statement for JH Limited for the year ended 31st October 2017 will be: the revenue will remain same, the opening inventory will remain same, just the transfer price will change, because now we have the new adjusted transfer price of $968,750. Because of this, the cost of goods sold will be changed, and Hence, the gross profit will be changed as it will be $879,250. Furthermore, in the working notes, I have showed that no doubt the gross profit have changed, but still the profit for the year will remain same as $481,000. This is because the increase in the factory profit will be equal to the increase in the transfer price, and both of them will cancel out each other. So in the answer, I have stated that the production cost or the transfer price originally it was $930,000, and the adjusted transfer price was $968,750. The gross profit originally it was $918,000, and the adjusted gross profit is $879,250. The profit for the year, however, remains same. Originally it was $481,000, and the adjusted profit for the year is $481,000 as well. So, in the suggestion, I have stated that the directors should not increase the percentage of markup, because I have supported it with various points. In the first one, I have stated that the selling price will also increase, because the selling price is based on production cost plus a markup. So, increase in markup will lead to increase in the selling price as well, and hence the product may become uncompetitive, and this will eventually reduce the profit of the company. Furthermore, the markup of JHPLC has remained unchanged in past for many years. It may be because the product has a demand which is price inelastic, and any increase in price may lead to a huge fall in demand, and thus the market may not accept the increase in price. So, by increasing the markup and if they follow the competitors, there may be a huge loss for JPLC. So they should not increase the markup, and hence they should not follow the competitor strategy. Thanks for watching my videos, and have a great life.